Save Rs.150,000 in income tax by using ELSS, Equity-Linked Savings Scheme. A sort of mutual fund called ELSS, Equity-Linked Savings Scheme, generally invests in equity shares of businesses operating in various industries. Investments up to Rs.1.5 lakhs in ELSS funds are eligible for tax advantages under Section 80C of the Income Tax Act, 1961, but only after a 3-year lock-in period. The following are a few of the main advantages of investing in ELSS. Tax benefits. According to Section 80C of the Income Tax Act, investments in ELSS up to Rs.1.5 lakhs are eligible for tax benefits. This entitles investors to a deduction from their taxable income of up to Rs.1.5 lakhs, which can result in considerable tax savings. High potential returns. Equity shares, which have the potential to produce greater returns over the long term, are the main investment of ELSS funds. During the past 10 years, ELSS funds have historically produced returns that have ranged from 12 to 15% annually. Low lock-in period. ELSS funds have the shortest lock-in duration of 3 years among all Section 80C tax-saving investing alternatives. This implies that investors can withdraw their deposits after 3 years if they need the money. ELSS funds invest in a diverse portfolio of companies from many industries, which helps to lower the risk of having concentrated exposure to one industry or business. Systematic investing. With SIP, ELSS funds enable investors to make investments in a methodical way, systematic investment plan. In other words, investors can set aside a certain sum of money at regular periods, which helps to average out the cost of investing and lessens the effect of market volatility. Overall, ELSS funds provide a mix of tax advantages, high potential returns, diversity, and a brief lock-in period, which makes them a desirable investment option for investors aiming to reduce their long-term tax burden and amass wealth.